Welcome to AEC Unscripted M&A Edition, your go-to podcast for unfiltered conversations and expert analysis. Brought to you by Stanbaugh Ness.
Welcome to AEC Unscripted. I'm your host, Jeff Adams, the Director of Mergers and Acquisitions at Stanbaugh Ness, coming to you from Studio B, also known as my basement. Today we're going to be exploring M&A through the lens of a couple of valuation experts. Valuation is important in the M&A process to both buyers and sellers. Confusion around valuation and how it relates to deal negotiations can cause an otherwise successful union to never take place. I'm delighted to have joining me for this episode Tracey Eaves, Managing Director of Transition Solutions at Zweig, and Becky Carlson, Director of Value Advisory at Stanbaugh Ness. Thank you so much for joining me today, Tracey and Becky.
Thank you, Jeff.
Thanks, Jeff. It's great to be here.
Well, listen, I want to give everyone a chance to get to know you first before we get started. So if you want to take turns, Becky, why don't you go first and just tell people a little bit about yourself?
Sure, Jeff. Yeah, I started doing valuations probably in the mid-2000s. Before that, I had a different career in inventory control. I stayed home with my kids when they were little, and my husband asked me to go back to work because times were a little iffy in the economy, and instead I went back to school and got my CPA.
Wait a minute, so you went and spent money rather than
I did.
money, right? Okay.
Yes. He was like, okay, but it gave me more opportunity, I think, having a CPA. And then the first job I got after that was being a controller and outsourced CFO for engineering and architecture firms and clients. And I went on site and did their books, which was so important for me to learn about financial information in this industry. And the person I worked with, we worked through PSMJ Resources, doing valuations and M&A. And so I learned how to do valuations before I was certified. And then I went back and said, I'm doing this. I really need the credentials to make sure I'm doing it correctly. So I got ABV, which is an accredited business valuation certification, and realized we were doing a lot of things
sponsored by the Small Business Administration. I ended up as the center director for 2 different SBA programs. And out of that process, of course, we were associated with universities, and there was always a continuous and began as presentation. And about 3 hours later, I turned around and looked because there was some commotion in the back of the room. The room was almost empty. But I walked out of there and I said, this is the most interesting thing that I have been exposed to in a very long time. And I think this is something I would like to pursue. The dean I was working for at the time was encouraging the continuing education. And so I went back to the office the next Monday and I wrote a proposal to the dean and told him that this is what I'd like to do. He reviewed that and said, get going. So I started with the Institute of Business Appraisers and went to my first program in Myrtle Beach, South Carolina. That was probably about 1998, 99, somewhere in that neighborhood. So 25 years later, I have been in the valuation business for 25 years. I've got multiple certifications in valuation. I've also got a machinery and equipment appraisal designation as well. I have been in the world of AEC for the last 15 years working with Zweig Group and have really enjoyed the industry. I really enjoy the people in AEC. I like working with people who are in the professional services business and a lot of very smart people. So it's fun. It's just a fun industry to work in, and I have thoroughly enjoyed it.
Well, thank you both. It's great having both of you join me today. And it sounds like you both are the right people to have here on this topic of valuation and M&A. So let me ask you, when should someone consider getting a valuation?
Oh, Becky, you want to take that one?
Maybe before we go there, Becky, What is a valuation? Just throw that word out there very easy, but what is it? What are we talking about when we say valuation?
Yeah, so valuation is pretty much an analysis of what your investment is. And you think about it, what do you mean investment? Well, it really is looking at your company and saying, what is the worth behind it? What makes up the company and what's the dollar amount assigned to it? And you think, wow, that's crazy. How can you assign a dollar value amount to a living and breathing entity? Well, that's the art of the valuation. And it's a way to communicate a really complex story in a report format that people understand. So buyers and sellers could both talk to each other, I think, with that. I don't know, Tracey, what do you think?
Yeah, well, I would say, some people are probably going to say, I already know the value of my company because I can look on the balance sheet and there's this little section that says equity. And so people are going to say, well, why do I need you? Because my balance sheet says that. And frankly, if the balance sheet was the proper representation of the real value of your company, people like me and Becky wouldn't be in the business that we're in. We would have had to have found something else to do. A valuation is not only determining what the market value of the tangible asset component of the business is, but it's also determining what the intangible asset component piece is. And you will hear a lot of different terminology thrown around. You hear blue sky, you hear all kinds of different terminology. Goodwill, I tend to refer to the intangible asset component, particularly in AEC, as a bucket of the goodwill component. Now, there are different elements to that. There's a workforce in place, there's a customer base that's in place, there's some other things. But if we think about it in a broader sense, that goodwill component. So, from the perspective of the intangible value, that's nowhere on anybody's balance sheet. And so, what our purpose and process is to determine not only what the tangible value is that is reflected on the balance sheet, but what's the rest of it and how is that achieved. Typically that's going to be achieved through the measurement of the performance of the company, the profitability of the company, and how that ultimately develop into a cash flow stream that would be available to the investors or the shareholders in the firm.
I think that goodwill term's a good one to bring up because in M&A, when a lot of deals get done, we always have this purchase price accounting that has to take place after the fact. Record, okay, what did you acquire? We know we bought some AR, we bought some WIP, work in process, we bought some vehicles, things of that nature. But there's always a really large chunk that gets put toward goodwill because firms are trading much higher than the book value, i.e. the equity shown on their books. As a result of that, I think that's a good analogy and kind of ties things together a little bit for our audience. So what are some times that people should consider getting an independent valuation, and why get an independent valuation versus just doing it yourself?
I think doing it yourself is almost like valuing your baby, right?
It's always prettier than my baby
Yes,
is prettier than anybody else's baby.
exactly. And this, I know the worth, and then you think, well, or let me stop myself. I've heard Sam down the street got a 10 times EBITDA for his value for his company. And so mine must be worth the same. And the valuation comes at it really holistically because I think talking about that goodwill, it's one thing to look at your earnings and the company and say, well, I've been making 500,000 a year. That will continue into the future. Well, it may or may not. So there's risk associated with anything that you're doing. And some of the risk is economic risk. It's coming from what's going on in the economy, maybe geographically, in the industry, maybe in your market, but it's also what's the risk of your own cash flow. So the valuation takes a lot of inputs, and having an independent one, especially someone that's really keen on this industry, is just going to help you take a look at your baby and say, yeah, your baby is gorgeous. However, your baby doesn't know how to walk yet, and this is what people are looking for. So I think it's a way to communicate really complex thoughts into something that is usable for you to communicate, whether you're going out to sell or you're going to buy.
Yeah. Either way. Either way.
Yeah.
And I would say, even adding to the list, and Becky, that was a very comprehensive list of the things that we think about. Um, you know, Sometimes I think that looking at the next level of leadership is a huge component piece of this as well. But really, from the perspective of the valuation, doing it yourself, as a business owner, it is almost impossible for you to divorce yourself from an independent opinion and a disinterested third party, because you're always going to have a vested interest. And so we can come in and take a look at that from purely a disinterested third party opinion, because other than our valuation fee, we don't have a vested interest in the company. And ultimately, if it transacts or it doesn't transact, or you're going to transact and buy another firm. So it really does allow for that purely independent opinion and deep dive into the company. We're looking at things that you as a business owner may not even be thinking about, that you would consider to be a risk profile when we do. So there's a lot of good reason why the impartiality of what we can bring to the process, I think, is very important.
Yeah.
I imagine you don't have very many people come up and say, "Hey, I'd like to get a valuation, and I don't really think we're doing very well, and you know, don't look really good, and don't think I'm going to be very valuable." Right? They're usually coming and saying, "No, I think I'm worth more than what they probably are." Or what do you see?
Well, I will say that from the perspective of valuations, we're doing valuations for a myriad of reasons, but sometimes we will have clients. I've had this happen several times where I've had clients, and it somewhat tends to be maybe more on the architecture side of the equation, where they've had a very massive project that they've worked on that really helped to bolster their revenue stream. But they're also understanding that is not something that is going to be sustainable for them to continue to grow from that starting point
Mm.
forward. So sometimes I will have clients come and say, look, we had this very major project. It lasted a couple of years. We know that we're going to be down for the next two. And so we need to understand, how does that ultimately play on our value indication? And a lot of it too is coming at it from the perspective perhaps of internal share transactions, rather
Mm-hmm.
than an M&A transaction. But sometimes it's also just about the longer term look at the corporate planning process for people who are perhaps thinking about selling in the market, but they're not quite ready yet. And they want to understand how the decision making process that they are investing in today is ultimately going to have an effect on perhaps what they could see in a transaction in another couple of years.
Absolutely. Yeah, it's almost a mini due diligence process for them.
Yeah.
You're getting ready to sell. The valuation will really inform you of what you're doing well and what your risks are. So I think that example of the project risk is really a good one. What phase are you in a lot of your projects? I mean, we know profitable phases are usually at the beginning of projects. And if you're looking at a couple years of great net income, but you're walking into a CA phase on 5 of your 6 top projects, you know the next years aren't going to be that great. And you may not even be aware of that. So that's part of, I think, the valuation process, is looking at that company specific risk, especially in this case, the project risk, and how buyers would look at you.
Sure.
Yeah, so a lot of different things to consider during evaluation, and how really to determine what is it worth today, is what I'm hearing there. What are some of the valuation methods used? Maybe more broadly speaking, but then what do you see typically used in the AEC industry?
Mm-hmm. I
Well,
mean,
from the perspective of appraisal itself, just in general, we are trained to look at and consider 3 different approaches to value, much like a real estate appraiser. So there will always be the consideration of an income approach and what is the appropriate methodology within an income approach. There will be a market approach consideration, the appropriate methodology there, and an asset approach and that methodology. Typically, in professional services, the asset approach is much less viable, just simply because a lot of the value that is wrapped into these firms is on that intangible side that we don't see on the balance sheet. So it is, at least in my practice, Becky, I don't know about you, but at least in my practice, the asset approach is something that I typically just don't consider for professional services firms unless we have a firm that is perhaps maybe a little bit more asset intensive with heavy equipment or a lot of equipment investment, or perhaps they own some real estate or some other investment inside of the corporate entity, and then it's worth a consideration. But I would say most of the time the valuation is going to be driven on an income approach methodology and a market approach when the data is available. Becky, I don't know if you're in the same thought process.
Oh,
Before you say that too, Becky, Tracey, I think you're talking about the asset base there. Just want to tie this back together for the audience. That ties into what we were just talking about a while ago about the equity on your balance sheet and
Sure.
book value, right?
Yeah.
That's really what we're talking about. And being that we're not, the AECs typically, or at least the AE is not typically an asset intensive industry. Some might have some vehicles, things like that. Get on the edge construction side, you start having equipment. Now it gets to be more
Sure.
asset intensive. But professional services, as you said, is not very asset intensive. And as a result, what a firm's worth tends to rely more on its cash flows and market than it does on what the book value would say that it's worth or the assets would say they're worth.
Yeah.
right. There's always those one-offs. We
Yep.
have a client down in Louisiana who buys his own equipment instead of renting it, does a lot of drilling, exploring, surveying. That is a one-off. In that case, if you believe the assets are worth more, you may want to consider that. But ideally, those assets are generating cash flow that's supporting the company. And so those income approaches, methods are really, I think, always used. At least I do, always an income approach. The market approaches, that's really preferable, I think, for M&A. The big problem with that is, what are these firms actually selling for? Privately held firms do not advertise their sale price. So we are constantly working with, do we have great data? I mean, we're blessed to have Jeff and Tracey supply the touches they have, and we need to try to compare our firm against those. But that's really what that market approach or market method means, is if I could buy a firm like mine for 5 times EBITDA, then this one is worth 5 times EBITDA. But it's trying to get them to be similar so you can use a similar multiple. That is the challenge.
Yeah, market data is a challenge. I agree with you, Becky. It's one of those items that does have some scarcity to it. Even though we also have access to databases that the appraisal community uses, sometimes the relevancy is just not there, and there's not enough to properly represent the total market. It's just too few data points. The other thing I will say with the market approach methodology is sometimes the historical financial performance of the firm is not indicative of its future. And we also have to be thinking about that. That is where experience, number 1, comes into play. 2, it's also about having a really good and quality management interview process with management that we do, so that we have a deeper understanding after having had a chance to look at an initial analysis process. But sometimes that is the case. And particularly with firms that know that perhaps they're about to win a very large contract that is going to be that next step up. And I see that particularly with smaller firms. They've rocked along and they've been in the $2 to $3 to $4 million range, and all of a sudden they get an opportunity that comes along that really is going to increase their revenue stream. And then come back and do a valuation of them 2 or 3 years later, and they've been able to sustain that. So it's fun. It's really fun to be able to work with firms that do take those steps up. But sometimes that is the case, is that they just take a step up and they get in a different market or they get into a different client base, and it's a sustainable revenue stream going forward. So if you had that situation, a market approach methodology, because it's always backwards looking, sometimes is not appropriate in those cases. But again, I think Becky would agree that is the decision of the appraiser, and using our judgment as to what we feel like is reflective of the market and how an investor would look at a firm and how they would not.
Speaking of market, I think about market multiples, right? We hear that all the time. I mean, you go to different M&A conferences, they talk about multiples. Tracey, you and I intentionally did not talk about multiples at the M&A Next conference because sometimes they're misleading, right? How do you as valuation experts handle market multiples? There's a lot that goes into it. I tell people all the time, right? That's a byproduct. That's not a driver.
Yeah.
How do you take that information, and what's some of the complications maybe that you see with market multiples?
Yeah. Market multiples, they serve a purpose because they're really easy to compute. So if you think about what we mean by market multiple, it really is what is the number that your earnings is multiplied by, and that creates value. So when we say 5 times EBITDA, what we're saying is the value of the company is 5 times your earnings. And very simple to understand, to compute. And many larger firms that are in this industry that are buying firms, they may start with a market multiple when they approach you. And they'll say, hey, I'm going to offer you 5 times EBITDA. Oh, things look really good. I'm going to change it to 7. And, that conversation starts from there. But really, what is in that EBITDA, earnings before interest, taxes, depreciation, amortization? That's what it means. What is that earnings made up of? What are the unique characteristics that maybe can be peeled back? That's really important to look at. What are the one-offs on both sides, revenue and expenses? And also, it is a rule of thumb. So I do use rule of thumb in valuation. I look at all of our sources of data that are available in the general valuation community as well as industry-specific sources. I always subscribe to all of our competitors' data. I mean, before we were partnering with Zweig, I ordered their report every year. I couldn't wait for it because it was another source of data, another source of rules of thumb. And they do tell a story, but it's a simple story. Really, it's a little more complicated when you think about what goes into both of them. The multiple is really a return on investment. So like a 5 equates to 20%, if you think about it. 100 divided by 5 is 20%. So that means they are expecting a 20% return on their investment. And if you think about that, that is pretty high compared to the rest of the world. In privately held firms, it's not necessarily outrageous, but that's all it is. That multiple is really just a return on investment. And what are the risks associated with that?
Yeah, and I think on that market multiple too, the EBITDA side of it, Becky, that you brought up, from an M&A perspective, that's something I hear people throw that out there. And my first question is, well, what is that EBITDA? In addition to the basic calculation from the financials, is what adjustments have been made to it? What add backs have been put into it? What normalization of compensation for executives has been put into it, or for owners? You don't really know. When you're dealing with all this data out there, they're self-reporting. You don't really know what they're doing. At the end of the day, you're having to trust that people are getting it right, if you will.
Yeah.
So that's always a danger. I tell people, hey, when you think about EBITDA multiples, that's your guardrail, right? It keeps you between the ditches, but it doesn't tell you what lane you're in.
Yeah.
And I will add to that, I think we've all heard it. Well, so-and-so, I heard that they got a 10x or they got a 9 or an 11 or whatever. And it all sounds so super sexy, right? I think every business owner would go, I want one of those. I mean, who wouldn't? But my first response is always, sounds great, but you do not know what the deal terms were. So it could have been that there was some unfavorable deal terms from the perspective of the seller, and the seller said, okay, I'm willing to accept this deal term. I'm not in love with it. I'm willing to accept it, but I've got to have a higher price for you, buyer, to put some more risk back on me. I have confidence that it can happen, but there are some things that are also out of my control, market forces, economic forces, different things that could happen. So when you hear multiples in the market, you do not know what those deal terms were.
That's a great point, Tracey, because there could be huge tax implications to the way a deal is structured, right? And they might have accepted an asset purchase. A seller might have accepted an asset purchase, which could have greater tax consequences on them, but the buyer was
Right.
willing to give a higher purchase price to help offset part of that.
Absolutely.
So that's just one example.
Sure. Or the other thing that you also have to think about is what was the driving factors behind the strategic interest from the buyer's perspective? What was their strategic value interest, and how much? If you took a firm and you put that firm in front of 3 or 4 or 5 different buyers in the market, and you said, okay, everybody, you all have the same information, you're all going to look at it, and you're going to come back with a quote offer. If you interviewed each one of those companies separately and said, regardless of some of the mechanics of cash flows and different things, as the buyer, what are the strategic elements to this particular seller that is attractive to you, and how much influence did you allow those strategic elements to have? I guarantee you would get 5 different answers. And so that is the other thing that we don't necessarily know from some of these transactions, is because we don't have a lot of the data to understand. Sometimes we have very little. So we don't have the data to understand all of the financial component pieces of it, in addition to perhaps what some of the strategic value element could be as well. So there's a lot going into that. And just coming back to what Becky said about, hey, you might start at a 5 multiple, but the reality is a firm that has a 35 or 40 day collection period on accounts receivable the same as a firm that has a 120 day collection period on accounts receivable? And the answer is no.
Right.
And there's a lot of reasons why Becky and I both yell no. A lot of it is it's risk profile. It is the need to have working capital that supports that receivables collection period. There's a lot of different elements that go into that. It's probably part of the client profile. It is probably also the fact that you've got perhaps a firm that is sitting in a primary position versus a firm that is doing a lot of subcontract type work that has a longer collection cycle. And so is their cash flow stream at more risk because they can't control like the other firm does? And the answer is probably yes. So there's a lot that goes into that consideration. So when people are talking multiples in the industry, just keep in mind that there is so much noise in that data that there is no direct comparison, period.
So I think what I'm hearing, summary on that, is income is the preferred approach overall in the AEC industry, with a little bit of reliance upon the market approach, and then the asset approach kind of way down on the list in an M&A context generally anyhow.
Right.
Yeah.
Unless you're a big C firm, right? But construction management company, if your people are your biggest asset, you're really going to rely on income. And then, yes, the market is still informative. I like what Tracey said about it being backwards looking. What that means, if people don't understand that, is it's looking at historical earnings. It's not looking at projections. So the income approach gives us another way where we can project the future and actually monetize that, which we don't necessarily do in the market approach. It's more of a stagnant approach.
Yeah.
So people get valuations for multiple reasons. We mentioned M&A. We've mentioned internal stock trades. Maybe there's trust. Maybe there's an estate
Estate planning. Yep.
planning kind
Estate
of issue.
settlement.
Yeah, and estate
Yep.
settlement, things of that nature.
Worst cases.
Well, how does the purpose for the valuation impact your approach to valuation? Is there any change? Does it matter what the reason is for? Or is your approach the same, or what does that look like?
Yeah, it does reflect what the standard of value is that we have to use. So, fair market value is a term that is used most often in this case, where we're valuing based on a hypothetical buyer, hypothetical seller, and neither one is under any compulsion to buy or sell. And I liken that to if you go to an auto dealership and you want to buy a car, you kind of know the price that's going to be there, especially now with the internet. It's really hard to have a lot of differences. And you don't have to buy from this company, but you want to buy and they want to sell to you. So it's kind of like that market price.
Hmm.
If you were talking about something where fairness opinion after the deal is done, an M&A deal, and the shareholders want to know, did we pay a fair price, then that would be a fair value assessment. It has a little bit of different connotation. It could mean that there isn't a hypothetical buyer and seller, there's a defined buyer and seller. So the terms are a little bit different and they inform us as valuators what rules we need to follow. And I think we had also talked a little bit about the strategic value, which is a value above and beyond fair market, which
Mm.
is subject to interpretation, but you can think of it as kind of a control premium where I'm going to get 100% control of this company. And I have been looking for a company who does healthcare in Austin for 5 years. And I finally found one that culturally I like. They have room, their utilization isn't off the charts, so I know that they
Checks
have
all the boxes. Yeah.
exactly. Then maybe I'm willing to pay above and beyond that
Yeah.
fair market value.
And that's where some of these market multiples come into play. And Becky's right, and the strategic value. So I tend to think of fair market value as the value to the universe of buyers that's out there in the
Hmm.
market. I think about strategic value, and there is definitionally in the appraisal community that strategic value is the value to one identified buyer.
Hmm.
And we're still making assumption about that identified buyer, but at least we know who that buyer may be. But the purpose of the valuation is it helps to frame the scope of work that has to be done. And whether it's internal share transactions where we're going to be valuing a minority interest in the firm, or if we know that the valuation is going to be done for the purposes of a sale of the firm in the industry, then we're probably valuing at the total invested capital level rather than the equity level, because we know that a seller has to deliver the firm debt free. And so, depending upon what it is we're doing, there are mechanically some different things that we have to think about with regard to the scope of work.
Okay. So the approach is pretty much the same, it sounds like, but there's certain levers you have to look at
Yep.
and think about depending upon the unique circumstances.
Yes.
Let me ask this question, try to tie that conversation to what we just heard, because you brought up the strategic value versus the fair market value. And then, Becky, you mentioned this fairness opinion, saying here's a known buyer and seller versus the hypothetical
Yeah.
buyer. Is the fairness opinion, since it's dealing with a known buyer and seller, giving you something more like strategic value, or is there still a difference
No,
between
not
those two?
necessarily. Yeah,
Okay.
it's really following a lot of the same rules, but the purpose is different. So, yeah, there's different rules you need to follow. Another example would be firms that have bought and they have it on their books, that goodwill component that we were talking about, which is the difference between the assets that you bought and the intangibles, goes to goodwill. Well, some firms need to test that to make sure that it hasn't gone upside down, that their investment is still worth what they paid for it.
Mhm.
So they will do a valuation for goodwill impairment purposes, and that follows that fair value rule. But you use the same methods. It's not necessarily strategic. It's used just for other reasons as well.
And that's where the science part of it comes in, right? So
Yeah.
what's the difference, while we're on that topic, what's the difference between what an offer price might be in an M&A scenario versus the strategic value? Are they pretty much the same, or fair market value? I mean, how do you think of all that? How do those relate? Because I know I see buyers and sellers get that terminology confused all the time.
Well, again, going back to the scenario of if you put a deal in front of 5 buyers, they would all look at it very differently because they all have different strategic objectives. Their offer price is perhaps reflecting their assessment of the overall value based on their strategic initiative, which could be daylight and dark between buyer A and buyer B. So, from a seller perspective, some of it's going to come down to the objectives of the seller or sellers in the process and what their collective goal is as a group of shareholders to sell the firm. But then from the transactional perspective on the M&A side, you've got to go a layer deeper than that. And actually, probably a couple layers deeper. You've got to go another layer deeper from the perspective of not only what's the collective goal of the current shareholders, but then the next level would be what are the individual goals of the shareholders and what they need to achieve out of a transaction. And then you go another layer deeper, and it is what are the goals or what do we want for that next level of leadership who may not necessarily be a shareholder upon the transaction date, but they are the people who helped drive revenue streams, grow the business, and all of that. And so, what does that group of people need from this transaction? So, when you start as a seller, begin to think in the layers of the goals and how you have to match all that up. Then you begin looking at the deal terms that are offered by a particular buyer and say, does this meet the goals? And if it does or it doesn't, that is, in my mind, above the culture that Becky mentioned. Those goals have to be achieved, or I can pretty well tell you it's not going to be a totally successful transaction post close, post integration. It's never going to be as robust as it could be because people are just like, I'm okay, but I'm not like happy we did this. So those things have to be achieved. When you look at offer prices, again, it goes back to the multiples and deal terms. It's the same thing. You can look at an offer price, and my goodness, if you looked at offer prices just at the top level, they could, number one, be all over the map. Two, some of them are going to be incredibly attractive on their face. But if you don't look deeper, and if you don't look at the deeper layer of what those deal terms are, it's going to be very difficult to compare because you're just going to have, again, a lot of strategic objectives of one buyer is going to look very different than the next.
Yeah.
Well, and we're definitely seeing that now, Tracey. I know you are too over at Zwei. When you're representing sellers and you take them to market, we'll see offer ranges wider than they've ever been on both ends of the spectrum.
Yep.
Yeah.
So,
I think you both mentioned terms and the importance of terms. So that letter of intent puts a number down, but then both of you know the terms on how you will receive the funds is quite different. And I've seen the reverse where the number is actually lower, that first number. And then I've told people, well, they don't want to buy your cash. So you have to take that offer and add your cash to it. That gets you closer to value. But then the terms, quite different, right? And how do you navigate that? I mean, I've talked to both of you about trying to compare different offers to present value in some way.
Yeah. Sometimes it is about a comparative to a present value number, but sometimes there are other elements in play that sellers value more than maybe the biggest number in the group of buyers. That could be, I have a desire as a seller to be able to maintain as a legacy the name of the firm. It's important to people. And so sometimes those things can be as valuable to the seller or sellers as a number on a piece of paper that is going to maybe result in cash somewhere down the road. So when we're talking about this from the M&A perspective and deal terms, it becomes a much deeper conversation than just looking at market value. And then you start looking at the terms, and then you've really got to be thinking about the achievement of all of the other things that people are trying to achieve out of selling their firm.
Yeah, to that point, Tracy, recently we've been seeing things with this talent shortage that we have in this industry so much. It's quite common to see sellers say, I'll opt for the buyer that can solve my number one problem the fastest. And that's that I've got more work than I've got people to do the work. And if you've got a geographic presence where they are such that you can get your people onto their projects,
Isn't that crazy?
they'll take that over the price.
I know I tell people if you're selling, it's almost more attractive to have a 55 to 60% utilization than a 70 to 75 because buyers are looking for qualified, talented team members. And that is more attractive. Being a little underutilized, which I never thought I would say.
We will hold it against you, Becky.
Yeah. It's good that you're not meeting the median.
Well, I think this was good discussion though, because it helps people understand the wide range, of what can happen in a valuation. I mean, as valuation experts, when someone comes to you and says, give me a valuation, when you're dealing with an unknown entities, right? You don't know what purpose it's going to be used for. And you're having to kind of just say the average, right? The law of averages kind of come in here. It's going to give you one valuation versus if you're sitting here dealing with a known buyer and a known seller, and you're able to know what the strategic synergies are of putting these two firms together, what the cultural synergies and likeness are between those two firms, that really can drive the value in an M&A transaction. I mean, we say beauty is in the eye of the beholder. And when you get the right beholder looking at you, the price follows because everything just lines up perfectly.
It does, but something I would like to throw out there too, and particularly for any sellers who are listening to this. If you think that you have a buyer and you're going to take every strategic element and add it to your valuation as the seller, that probably is going to be a disappointing exercise for you from the perspective of actually achieving a transaction. Because sellers, you have to remember, one of the reasons that the buyer is also looking to buy you is because they see upside potential in combining you with their other investments and other firms and all of those things. So while you can take some of that into account, ultimately, you're not going to achieve every dollar for dollar, because then why would the buyer buy you? Because there's no upside potential for them on that front. So there's a lot, again, this is so much deeper than just numbers on paper. And I think that's just one of the things that becomes very difficult to discern, is that in itself.
We're getting short on time here. I just want to kind of lead into one thing. What are some of the common misperceptions that you see and hear when it comes to valuation and AEC?
Well, something I do want to throw on the table, and this relates to the last topic we were talking on, and that is the strategic buyer element and achievement of people exiting firms. That's something that we at SWI Group see. It's not every time, but there are certainly times that we see this too, is that sellers, you have to be thinking about your exit strategy and when you are going to sell your firm. We still have a lot of the baby boom generation that are shareholders, especially the smaller firms. Sometimes you may have an ownership group that is approaching that retirement age category. And certainly buyers are going to be thinking about that from the perspective of what does the runway look like for the leadership group in the firm that is currently leading. And then they're going to be looking at the leadership group that is the next level. And those elements are also going to be very critical to the overall process. And Becky, I'm sure that You have from time to time looked at the ages of some of the ownership group, thinking about that from the risk profile perspective of particular companies that you're valuing. And when there's not a depth of leadership and there's not much depth of the bench there, and you've got an aging shareholder group or shareholder in a lot of cases, it adds some element of risk.
It does.
From the,
And
yeah,
I just wanted to add to that. I think knowing that you as an owner will have to continue to work for a while. And
yes,
I think sometimes a misconception is, well,
Mhm.
I'm going to sell my firm and tomorrow I'm going to the beach. No, you have to stay. And that's why I think if you are thinking about retiring in 5 to 10 years, you should be already planning, right?
yeah, yes, absolutely.
Because
And
you'll have to continue.
Mhm.
yeah, and if there is some reason that you cannot continue to work for a period of time, then you need to be prepared in your mind that while you might get offer or offers, if you can't stay for a period of time, particularly if you are in that lead category, buyers will tend to suppress value and offers because of that element. So it's definitely something that if you're thinking about it, if you're thinking about selling, you've also got to think about what does that runway look like. So that is
Yeah.
definitely a misconception that you're going to get to go to the beach the next day with a
Yeah.
pocket full of
And
money.
I think another misconception is the firms that maybe have a culture of rewarding employees and taking home a lot of the value during the time they own. So, in other words, you reward your team well, you take yourself a large paycheck and distributions, and the company itself is not necessarily a shell, but the value of the company is distributed.
Mhm.
And
Mhm.
to think then that you will be able to sell it without add backs is a misconception. For example, if you're an owner and you're paying yourself quite well, maybe you're paying yourself 500, 600,000 a year, you probably won't get that same salary if you're selling. You're going to have to fit into their structure. So what you need to think of is that you've been rewarding yourself along the way,
Mhm.
and that there's no, shall we say, double dipping. So the
Mhm.
value of the company, there are add backs, but they're add backs. So of your company from the eyes of a buyer, I think, is the main goal of valuation, as well as looking at your industry metrics, your KPIs, your benchmarks. How do I compare to peers? A lot of times we're so busy. I know we do this at Stand By Us. We're so busy doing our business that it's like, well, we think we're great. How do we compare? So I think that's a huge component of the valuation. Is it is an eye-opening experience so you can understand better what qualities you have that are valuable.
Yeah. I would say another misconception is probably the element of time itself. It takes time to go through the process. So it takes time to do evaluation. I hope that anybody who's listening today understands that this is not something that we're throwing into some kind of a software program and spitting out a number, because there's way too many qualitative component pieces of this to be able to do that. It takes time to do the valuation. And then, of course, it takes time to bring a firm to market. It takes time to market that firm. It takes time to talk to buyers. It takes time to get to a term sheet. It takes time to get to an LOI.
Mhm.
It takes time for due diligence, and it takes time to close. And so, somebody who's in a super hurry, there's only so much compression that can be done in that process. There is a time element to this. And if you are thinking about selling, you probably ought to have in your mind that this is going to be a good 12-month process at a minimum.
One last thing I could think of is working capital. Talk about that a
Oh,
minute when it comes to valuation, and how's that considering working capital, and what are some misconceptions you see around that?
Yeah.
Becky,
I'll
you want to take
start.
a
I'm
stab at
sure
this one?
Tracy has a lot of war stories about that, but working capital. So what we mean by that is really the funds that are available to the company to keep it going. So typically working capital is going to be your accounts receivable. It's going to be your work in progress. Simply subtracting your accounts payable gives you working capital. So that's the simplest way of looking
Mm-hmm.
at it. And that really is the money that the company needs to continue working, continue to pay the employees, collect, bill, and sustain itself.
Mm-hmm.
So that is always going to be a component of that offer. You will have to bring some working capital to the table. So sometimes people get caught up because they think, well, that should have
That's mine.
value. Yeah.
Or
Like I
that's
worked
mine.
really hard for that. But it's more of a business concern, an ongoing business concern. So what does that mean? Well, it means you want to keep it really clean. You want good working capital. There's going to be a look back period, but you want to make sure that you have what you need, but not too much,
Mhm.
and that you don't have old work in progress, for example, that's never going to be billed.
Yep.
The risk, I think, is that a buyer will come along and they'll say, well, I don't want anything that's over 90 days because I don't believe you're actually going to be able to convert that. But I need your 12-month average. So, et cetera, et cetera. But I don't know,
That's a
Tracey,
great
you probably
point, Becky.
in your,
Yeah,
in your
the
deal.
receivable. Yeah, and and talking about some of the old stuff like accounts receivable, you need to understand that your accounts receivable collection cycle is going to also drive the amount of working capital that you're going to have to deliver at the
Mm-hmm.
time of the transaction. And so if your working capital collection cycle is maybe what it is just because you haven't ever had a very dedicated and intentional process to collect receivables in a timely fashion, that's going to ultimately penalize you in a transaction. So if you are thinking about selling and you look at your receivables collection cycle and you go, we could probably tighten that up, man, you need to start today. Start tightening that up because you need to have a demonstrated track record of at least a year or two that what is the older data is pre-intentional collection process, and the last couple of years are very intentional collection process, because that is going to also drive a lot of the discussion around what that working capital target's going to look like in a transaction.
Mm-hmm.
Yeah, I was going to ask the question how sellers can prepare themselves for sale with the goal of maximizing their valuation. I think you just hit on a big one there, Tracey. Working capital can be a big number, and for a sizable transaction, working capital can be millions of dollars to
Yeah.
be negotiated either way. And the better you manage your working capital, collecting your billing as soon as you can, collecting your receivables as quickly as you can definitely help you drive a lower net working capital target, which is going to mean more
Yep.
cash in your pocket when a deal closes. So,
Right.
Absolutely. And I would say that from the perspective of a transaction, one of the things that you don't want to do is you don't want to decide that post LOI, post term sheet, or post LOI with a working capital target number in it, that now you're going to start cleaning up your accounts receivable and you're going to start cleaning up your WIP, because you start moving big chunks of financial element on your balance sheets post LOI. It really makes that working capital target discussion more difficult to come back to once that target has been set. So if you have WIP on your balance sheet, take care of your WIP. Don't ignore it. We see too many times that that's one of those things that it's kind of easy to ignore. It's like the little pile of papers on your desk that it's like, I'll get to that one of these days. It's not critical today, but your WIP is truly important because it's part of your working capital. So make sure it's cleaned up. Look at some industry guideline data to see, is my days WIP number within a reasonable target range of what the industry looks like. Same for accounts receivable. You need to be running that and look at that over a 2 to 3 to 5 year period of time and say, is there consistency? Is there volatility? Is there something here that we need to clean up? Is there stuff that's hanging on because we've just left it there because we think someday we may get paid? And the reality is You need to move that out. If nothing else, put it in other assets, do something else with it, but get it out of your current asset profile, because that's what a buyer is looking at.
Right. And talking about accounts payable, do a pay when pay your subs when you're paid, keeping an eye on that.
Yeah.
And if you are going to market, you should know what you should have in working capital. And I think your point was well taken as well, that the time to talk about that is during that LOI phase, not 3 months later. And when you say, oh, well, my working capital was overstated because blah, blah, blah.
Right.
No, you should know going into it and have those conversations sooner rather than later.
And I will just come back and say, in my mind, that is a great, all of what we just talked about with looking at some of the analysis of historical data, all of that is going to be looked at in evaluation. So Becky and I, whoever's doing that work,
Yes.
we're looking at that. We're asking the hard questions before you get to a buyer who's going to ask you hard questions.
Right.
We're asking you hard questions. We're identifying what we think are issues that you need, that you as a seller and an owner need to go look at and clean up before you ever even get to market. So those are all things that evaluation would reveal.
Right. And it works for buyers as well. We can do valuations and give you our opinion on the quality of what you're trying to invest in. Mini quality of earnings. Like, we can tell you this is the good stuff and this is the stuff that might cause you some headaches.
Yeah.
Well, Becky, I think it was you that alluded to it earlier, the partnership between Zweig and SN. And for those that don't know, we did enter into a strategic partnership. I think it was in April of this year. And this was a great opportunity for people to see that partnership at work. Thank you so much for joining me today, and both of you sharing your insights and your back and forth and talking through the different topics. It was a real partnership. So thank you so much for that. Glad you could be here.
Thank you.
Enjoyed it. It was fun. Yeah.
Thank you so much, Becky and Tracey, for participating in today's podcast. And thank you for tuning in to AEC Unscripted, Mergers and Acquisitions Edition. I'm Jeff Adams, and it's been a pleasure guiding you through M&A from the perspective of a couple of AEC-focused valuation experts. Please remember to subscribe and leave us a review wherever you get your podcast. And until next time, keep pushing forward.